Over the years, there are always paradigm shifts. One gets used to a certain type of environment, and then there are periods of time where they shift to a very different kind of environment. For example, the 1920s were the exact opposite of the 1930s. So the transition from the 20s to the 30s shocked people. And so you come to periods of time where something has gone on for a long time, such as the easing of monetary policy, but also the quantitative easing. That paradigm, that leveraging up, for example, can't continue. But yet, late in cycles, people extrapolate that which happened in the past, and so there are these surprises. I think there are always these paradigm shifts. And I think by stepping back and seeing history from a longer-term perspective is very helpful. I think the Fed made a mistake, and I think the Fed understands that it made a mistake in assuming that this is a normal cycle. And what they thought was, if you pick up growth and lower unemployment, you're going to produce inflation. We're living in a different world now for various reasons, a world of a lot of excess capacity, a world of digitalization and so on, in which that's not the big thing. The big thing is the fact that we're approaching an end of the power of central banks to stimulate. So the big thing is that we have a very big asymmetric risk. If the economy turns down, and we're late in the cycle, so a downturn will come, there is a lack of ability by central banks to be able to be stimulative and to reverse that. And that's happening at a time where there's great wealth polarity. So if the left and the right, or the rich and the poor, are at each other's throats at this time, and this is when times are good, imagine what it's going to be like when we have a downturn and there's an inability of central banks to respond to that. So that shift in Fed policy, which came at the end of the year, was necessitated by these weakening conditions around the world. I think the key is us staying on top of these changes that we're talking about and responding to them. First of all, I think every portfolio should have the right amount of diversification in it. Gold is an important portfolio diversifier. However, let me be clear, I don't think anyone should have a concentrated portfolio now, okay? So people can hone in on one comment I'm making. I think that the notion of creating a balanced portfolio is the most important thing that they can do right now, because wealth can't so much be destroyed as it can be shifted. And so the world right now largely looks, to me, leverage long. In other words, there's been a lot of borrowing to buy assets, to buy companies. Companies have borrowed money to buy their equities back and so on. That whole move of leverage long is where the markets is. I think there's a vulnerability, what I'm saying is, to that kind of a portfolio, and that gold is one of the items that can diversify that. I believe it always should be a certain part of a portfolio because there's a certain environment that it diversifies the portfolio well, and a certain environment to worry about. I also think that that environment is riskier, more likely recently now. And that environment is one in which it becomes very difficult to stimulate the economy, and there's a desire to depreciate the value of currencies. Now think about a bond is really the currency. So when one owns a bond or one owns a debt instrument, one is paid a pile of currency over a period of time. When there are a lot of obligations like that, a lot of debt, or even unfunded obligations like pension obligations or healthcare obligations that the world has, a lot of obligations, and there's not an effective monetary policy to lower interest rates and stimulate, as we're talking about, there needs to be the printing of money, the running larger deficits. We're going to come into an environment, I think, in which there are going to be larger deficits that are increasingly monetized. And in that kind of an environment, the currencies are depreciated.